What is up, Connor? How we doing?
Hey guys, this is cool. This is like I'm tuning into CNN or something.
Well, let's go. Pete's
Well,
gonna
hey,
love
you
that.
don't come on. You don't come and attack me saying we're CNN here, Connor, on a Thursday morning.
Live show, I guess.
He's wants
Cool.
CNBC. CNBC.
Pete prefers CNBC, but I think
Yeah.
CNN's a step away, so he'll take it. Nice. So Connor, you're the co-founder of Permian Labs, which is building USD AI, a yield-bearing synthetic dollar backed by infrastructure, hardware, powering compute, energy, and telecom. So excited to get into exactly what that means, but wondering if you can kind of catch us up on kind of the journey you've been on with MetaStreet, which is kind of initially a NFT yield aggregator, into kind of this opportunity.
Yeah. So at the very beginning, started out working in finance for a few years. David and I, who are the two co-founders, worked together at an investment bank. And we originally started MetaStreet because in 2021, we were looking at what was happening with Uniswap and Aave as sort of these like 0 to 1 moments in financial innovation. And those products really serviced liquid tokens, which most closely resemble stocks and currencies. And we thought that there would be a natural progression to having like more of the structured credit, structured asset stuff that Wall Street does and is also kind of their crown jewel of financial markets. And so we started MetaStreet, and MetaStreet really is a structured credit protocol. So enables people to create permissionless pools and tranches of capital within those pools. And this was always supporting NFTs. And the thesis we always had was today NFTs are art and collectibles, but this is really a form factor for putting property rights to illiquid assets on chain. And so, there's a natural progression for this to ultimately look like a really robust CMBS or asset-backed securities market. And so we started out by financing like CryptoPunks and Squiggles and kind of dealt with the collateral that was available on chain. But really in the last couple of years, we've realized that maybe the more interesting category to focus on is those things that really naturally fit into an NFT form factor. And those assets that work best are typically things that are at least a little bit crypto adjacent. And so, if you think about DePIN and kind of this concept of organizing hardware is a really nice fit for a credit profile because you have cash flows, they're projectable, and therefore you can finance these, as opposed to art and collectibles, which are financeable in their own right, but no cash flows makes it a lot harder and volatile and all of that stuff. And so we started to look at, the compute space and GPUs, and what we realized was really besides the, AI lab side of the value chain, that business is really a CapEx business. People are buying GPUs, they're expensive, and they're renting them out for, 6 months all the way to 3 years. And so this was a really nice fit for the infrastructure we had already built. But we basically rebranded MetaStreet into USD AI to just focus solely on this product. And most importantly, some of the learnings we had was when you're, introducing 10 different pools with 10 different tranches and 10 different collateral types, that's a really hard thing for users to digest. And so if you can take kind of the underlying infrastructure and roll this up into a single yield-bearing token, then the users can kind of underwrite and come to their own opinions on how the protocol is valuing things and how cash is moving and where the property rights and all of that stuff. But ultimately, to execute that trade, to establish your position, is just mint a token. And separating that part out makes a much cleaner go-to-market and a much more digestible product for users. So we started to take in private deposits for USDAI a couple of weeks ago. We have about 30 million in deposits right now. We'll be opening a public launch in a couple of weeks. And yeah, I think this product has the ability to scale well into the billions of dollars of TVL and kind of pass through mid-teen yields back to users.
So, I mean, the number one question I think most people will have here is, what the heck is a yield-bearing synthetic dollar backed by infrastructure, hardware, powering compute, energy, and telecom?
Yeah.
Can you maybe just go into a little bit more detail there? Or?
So, naming conventions are challenging for this space because you have stable coins, and then people started to introduce yield-bearing stable coins, but they're not really, the stable part is less clear. And so You can call it synthetic dollar. You could think of it as a high yield bond index. But basically, this is the same concept as if you had CLOs or like auto loans, for example. You have a basket of auto loans. These are secured by the value of those cars as collateral, and then you roll that up into some yield product. And so this is exactly what we're doing. You basically have collateral being the hardware, the equipment, not business loans, and therefore you can have a very simple kind of evaluation and underwriting process and scale that up really quickly, because these assets are semi-fungible. So you can sell used GPUs in secondary market, off chain, not related to crypto, quite easily. And so that means that you don't, as a depositor, you don't have to underwrite business risk and all of the challenges that we've seen in the RWA space, where people are trying to do small business loans or something and roll that up. Well, then what happens when these loans default? You are going to go to bankruptcy process and all of this. But very, very simply, right? You have GPUs. Those GPUs have a value, and that value is based on basically the cost to either buy those new or buy those used, based on the ability to rent those GPUs out in the future. And so what the values are. They're generally pretty straightforward and easy to understand. And then you can create debt products that support that. These borrowers need the debt because the bigger a cluster they can build, the better contracts that they can sign. And so really this whole industry is just one big cost of capital game. And you'll see this, like CoreWeave, for example, has gotten so large now they can access much more attractive financing terms. And I think this is like comes into a little bit of what do you want this world to look like? We have a big bet that decentralized training and inference will end up taking market share and be successful. And if you want to run a smaller cluster of GPUs and earn tokens from Jensen or Ambient or Noose or any of these guys, you're not going to be able to go to a bank and get financing for that. But despite that fact, like that's a incorrect analysis that those banks are doing, because that GPU that's owned by that guy has no different of a resale value than the GPU that's owned by CoreWeave.
The idea that banks would be able to go lend against this is the funniest thing in my mind. I had to go pay my property taxes yesterday, and that was like a 45-minute ordeal in my local bank. So yeah, they're going to be a little late to this game, I think.
Yeah, and this is a very, very large market. Like when you think about the total size of, people will say it's trillions of dollars of assets and growing. And so when you think about what makes sense to do with crypto rails, if you don't have the kind of breadth of market that you have here, then these products kind of fail. And you really want to have the ability to say, these are mid-teens yields, and that clears the market. That's irrespective of if you're doing anything with incentives or anything like this. So mid-teens yield passed on to DeFi would be the highest unincentivized yield that you could possibly get. And the beauty of this is that wouldn't change if there's $2-3 billion of deposits there, because that's basically the cost of capital for this industry.
Can you help me understand exactly who the customers are on the kind of borrowing side? Like what do these companies look like? And I'm curious how I think they collateralize their loan with the hardware. I'm curious how that actually works. Like if they default, like how do you get the hardware to sell it and pay back that loan?
Yeah, so the profiles are basically a few different categories. You have neo clouds, and these guys are in the business of running clusters, putting software layer on top of this, and selling to AI labs. And so you have like mega neo clouds like CoreWeave, and these guys don't need access to capital. But there's probably 200 neo clouds that are have raised $10 to $50 million. And right now they're raising venture money, and they're using that venture money to buy depreciating assets. Makes no sense. But that market is closed off to them. So these guys are customers of ours. The other category that's also pretty interesting and developing is the folks who just want the equity returns of owning the GPUs, but don't want to operate and manage them. And so there are basically brokers who will procure the machines from the OEMs, like the Lenovos and Dells of the world, and then rent them out and just basically take a operating fee. And the reason this is really interesting for some traditional capital sources is there's a lot of depreciation benefits to owning GPUs. And so if you're in the equity position, you can basically bonus depreciate, I think it's about 60% year one of the purchase price. And so let's say you're a family office, you have a lot of taxes you need to offset. That's why they like this, right? So it becomes like a tax optimization game. And what's happening is these brokers and operators who are already in the business of dealing with the OEMs and dealing with the AI labs are realizing that they can plug in equity capital from family office types who want just this financial product. And so these are, the two categories that I would say are most prevalent. And then as the Jensens and Prime Intellects and Ambients of the world come online, I expect there will be a new cohort of people that want to earn these tokens and will be, completely walled off from financing. And so being able to support those guys too. Like we really think of this as financing the long tail of the AI industry. Because I personally don't believe that this thesis of, people are going to build bigger and bigger data centers and you're going to have like a data center that's 3 miles wide and has every GPU on the planet. Like I just don't see that being the like most likely path forward. I mean, even in Texas, the power grid is basically tapped. Like the path to nuclear energy is still 10 plus years away. So if you don't have a way to do this in a decentralized fashion, this industry will stall out. And so the incentives for decentralized training and inference are so high that it's most likely, in my opinion, that will be like where this whole kind of industry goes.
That's interesting. It seems to be that most of the conversation around decentralized AI is more of an ideological point of view, like
Yes.
the importance of decentralization. I hadn't heard it brought up as like a solution to the many, many scaling challenges that anybody who's building on the edge of AI is talking about, whether that's energy or new compute, et cetera. So that's super interesting.
Yeah, I think it's both, right? It's ideologically if OpenAI and CoreWeave and Blackstone, because Blackstone's the main, backer and financer of CoreWeave, if those three guys like control all of AI and ultimately create AGI, you can kind of talk all you want about alignment, but at the end of the day, those three companies are very much financially motivated, and those financial incentives will always surpass like whatever kind of alignment goals you set in place. But if you have decentralized training and inference that works, you could think of it as if the whole world is running these models, then whatever AGI looks like is fundamentally aligned with society as a whole. And I think that's great. Like I am very happy that we're on hopefully the right side of the ideological argument, but there's also just a practical argument here, which is that if you're doing decentralized AGI and you can't access financing, you most likely cannot compete with the CoreWeaves and the Blackstones.
Yeah, really interesting. So you guys so obviously the DeFi landscape is kind of insanely competitive today. But I saw on Twitter, kind of scrolling your feed, that you guys are the fastest growing protocol on Arbitrum, which is awesome. Congrats for that. So I'm curious what you think's contributed to that kind of early success and traction you guys are seeing. Is it kind of just a pure play kind of exposure to AI? I think often that's how I hear, public markets investors talk about CoreWeave and why that stock's been doing so well. So curious just how you think about positioning and kind of the early traction you guys have been seeing.
Yeah, I mean, if you look at yield-bearing stablecoins, StableWatch has a pretty good chart on this. It'll show where every yield is for these products, and it's basically between 5 and 8%. So I think like the very simple math is that people are seeing the higher yields and saying this is attractive. I want to go back to the other question you had before about how does this work in practice. So the way that we've been able to design this is very friendly to actually scaling without having, these huge bankruptcy concerns and, how do you unwind these things in a default scenario? So basically what happens is the borrower will buy GPUs and immediately sells them back to us. And then we create what's called a bailment contract. Bailment, there's only a few ways to actually create legally enforceable documents of title, and a bailment is one of them. A bailment is really like, you could think of this as if you were transporting, corn through a warehouse, and the corn bushel is sitting in the warehouse, but you own the rights to that corn, then the warehouse would be the bailee and you'd be the bailor. And so you can basically repurpose that contract for GPUs, which is the same thing. They're sitting in a data center. and they're, these servers, you own the servers, but they're sitting in, this kind of escrowed position. And so by minting these NFTs, we can assign the bailor rights to the NFTs. And then in the bailment contract, there's basically the borrower has the right to repurchase the assets after the loan has been completely paid off. And so the reason this is important for the, kind of default and unwind scenario is if that borrower defaults, they're not actually a borrower. It's not a secured loan interest. The bailor owns the asset. And so the bailor, which is the NFT itself, basically whoever holds that NFT can go back to the data center and say, I want this machine back. And you don't have to go through a bankruptcy process. So the entire default auction bankruptcy process, that happens completely on chain. And this is the same concept that we had with the MetaStreet lending pools as well. So as soon as you can actually like formally transfer property rights into this NFT, and this all fits into UCC. This is a new concept that UCC approved called UCC Article 12 that basically approves electronic documents of title as legally binding. Now that exists, so the only legal contract you're signing is just to create that document of title in the first place. Then the property rights are fully on chain. So that means that, when the borrower is executing their loan, you don't need a 100-page loan agreement because your loan is just predicated by what the smart contract dictates. And if you default on your loan, the rights to the assets are sold. And so even just, going back to the whole like concept of the practical limitations here, if you were a credit fund and you wanted to go and extend credit to these various neoclouds, you probably have $100,000 to $200,000 legal bill for every deal you're signing. And that means if you want to do a $2 million loan, like that's not worth your time, right? But we can do a $2 million loan all day because we don't have our marginal cost to sign up an extra contract is $0. And actually we almost prefer those deals because then when you think about your ability to resell those assets, if it's a batch of 8 nodes of B200s, that's a very sellable, digestible size of collateral.
Mm-hmm.
If you have $100 million cluster, like realistically, how many people can buy that? So you almost get this benefit of diversification by virtue of the fact that you are kind of participating on the smaller end of the long tail of the whole AI economy.
Yeah, that's fascinating. All right, maybe last question before we let you go. In your docs, you have a great line. It says, RWAs tokenize the past and DPIN creates the future. You want to say more about that?
Yeah, I mean, this was like our realization, right? So we spent a lot of time on other RWAs before we kind of landed on this category. And when you think about, tokenized real estate, how many times has that concept been brought up and people have tried to do that? And the challenge with doing something like that is that the debt market for real estate is probably the most robust in the world. So to be able to introduce so much benefit on chain that you can actually have good credit worthiness is very unlikely. It's almost impossible. I think that'll happen in 5 years, but not today. And so when we think about that category, like whether it's tokenized real estate or people that are taking obviously the Robinhood stuff, equities has been really hot, like tokenizing existing securities and putting them on chain. I think it's just a little bit unattractive because you're not actually creating too much value there. Whereas if you're taking an asset class that for fundamental reasons can't access credit and yet is credit worthy, and you can use crypto rails to solve that, I think that's where you can really create value. And I think that's where you invert this from a conversation of taking existing TradFi products and putting them on chain and actually creating crypto native products that then TradFi can come and eat up because they can't get access to this otherwise. This is why Athena was so successful, right? Athena was creating a crypto native new source of yield. And that's where, traditional capital providers get excited is you're actually introducing a new, source of value creation to the rest of the world.
Amazing, man. Well, I learned a whole lot here. I think
I was sick.
Yeah, I was like, yeah. I mean, it follows and makes a ton of sense, and it's been fun to watch you guys really take this core concept and really robustly apply it to a few different opportunities. And it really seems like this one is the best use of all that insight and brain power and technical prowess that your team has. So we're excited to be investors and continue to just love to see the progress you guys are making. So thanks for hanging out with us today. Feels like we should probably check in with you again in the future, because this DeFi meets AI space is, I think we're just at the beginning.
Yeah. Thanks for having me, guys. It was a great chat.
Thanks,
Peace,
Conor.
man.